Hi, everyone.
Hi, Christine.
Christina, hello.
Look, I'm gonna go on camera really quick, show you I'm a hot mess on vacation right now, but trying to not work, but I'm here. I'm gonna go off screen because, oof, it's been a tough day. All right,
Let me just verify if we're live.
we are live. Ooh, you didn't get me on camera live, did you?
I don't know.
One, two, three, four, five. We're good. We've got more than four for a committee. Let's go.
Okay, yep, we are live.
Good afternoon, everyone. Welcome to the Investment Committee of April 20th, 2023. I'd like to call the meeting to order at 4:34 p.m. Sue, could you do the honors of a roll call, please?
Angela Banks, Christina Bennett,
Present.
Lois Cross, Sheila Goodwin, Shanice Johnson,
Present.
Donna Jones,
Here.
Yvette Levy, Martell Mann,
Present.
Bobby Richardson,
Present.
Albert Sanders, Doris Walker.
Here.
All right, so we have 6, so we have enough for a quorum.
Thank you, everyone, for joining us. I'm assuming some will come in a little bit shortly. Is Louis joining us today?
I think so.
Great. We're going to go ahead and jump in, and we're going to let Gwelda and Jeff start our meeting off. We've got a lengthy discussion today, so let's just jump right in.
Okay, I think the first thing on the agenda is the conversation. Am I correct?
Exponents,
Okay, so Jeff and I had a call with Tina Williams and Charles Curry last week regarding the Exponents differentiated income portfolio. And in a nutshell, they basically told us that it is going to be winding down over the next 9 months or so. So they were giving us full notice. It's not something that's going to happen right away, but they want to give us full notice. As you know, the chief PM on that portfolio retired last year, and Charles Curry has taken it over. And there's only, correct me if I'm wrong, Jeff, what, 4, maybe 3 to 4 investors in there? And the largest investor has decided that they're going to transition that portfolio over to something else. So we listened to them and talked to them, and we told them we'd come back to them with a decision. So Jeff and I talked about it, and it's $11 million, approximately $11 million. And we thought about it and said, well, you already have 2 core managers, and what they're transitioning the other clients to is Core Plus. And so you have Earnest Partners and Manulife as your current core managers, and to add them as another core manager at a small amount, it would be somewhat duplicative. So we were going to suggest that you split the portfolio over time, over the next few months, and have part of it go to Earnest and part of it go to Manulife. So those were our thoughts on it. We did pull the performance for Exponents. It's called Core Opportunistic Portfolio. We verified that with Charles to make sure we're looking at the right one. And it does have a little bit more performance, not significantly so than Earnest Partners, but it's not a huge amount. We compared the fee schedules. Earnest Partners fee schedule is 25 basis points and Manulife is 30 basis points. So we know we'd be at the top of the scale with the Exponents portfolio. So no, it's a pleasure of the committee, but we thought just splitting the amount between the 2 existing core managers, we would that That would be what our Jeff and my thoughts were. And I'm open to any discussion you have here in this chart that was brought up on the screen. Manulife is the red square, Exponence is the blue square, and Ernest Partners is the yellow square. And taking into account, and the first one is returns, the second one is volatility, a standard deviation, and the third one is a risk-adjusted return to Sharpe ratio. So we I'm open to any
Well,
discussion.
I'd like to jump in.
Sure.
So just to give some perspective to some of the new members we brought in Exponents is twice on our manager list.
Mhm.
So we brought in I think it was Piedmont.
Yeah,
We brought in Piedmont, I can't remember what year we brought them in, and they were fixed income. And then they were acquired by Exponents. And then we ended up acquiring Exponents on the global side through our mandate for global equities.
right.
That's why you see them twice on our sheet.
Right.
The portfolio that we ended up going in, they were just, again, we came in, there was a big pension plan that had a majority of those assets, and they were going to grow that portfolio to a little bit bigger. But as we know, the risk with portfolio management and senior management, when you lose your core portfolio manager that was probably very good at the stylistic approach to this core plus portfolio. And when he retired, that necessarily doesn't mean that his style couldn't be replicated. It may have been that it just came out of favor with Exponents, and it wasn't Exponents didn't create this portfolio, they'd inherited this portfolio. So they kept it afloat as long as they can. And Lewis and I met with Exponents. They came in this week. We had a lengthy discussion over dinner. And I think we're all in agreement that we already have two other managers. I don't really know what the fee structure, what the cost is for Exponents on this portfolio. I know that Ernest Partners is 25, Manulife is 30, but what is Exponents on this portfolio?
It's the 35, I believe.
Right. So if you're going from 25, right, to 35, that's 10 basis points. We're not getting 10 basis points higher return for that core plus portfolio. And so that's what Gwilda was saying. You're going to be at the higher end of the fee structure and not necessarily getting that return for the active management of this style portfolio, even if we moved it from Exponents to the Exponents core or core opportunistic fund that they are currently proposing. So we had that tough discussion with them and said, we're going to have to look at really the fee structure and how it plays for us in the long run. Ernest Partners has been with us for a very, very long time. I would say mid 2000s they came in. Can you tell us, Gwilda?
I need to look at the report and see.
But I think they've been there since, I remember them coming in. And they are a minority manager firm. So we're not, we're not losing a minority manager. We're just, as Gwilda and ANCO is suggesting, is that we take that 11 million and allocate it towards Manulife and Ernest Partners. And I'm totally fine with that. If Manulife understands that we're going to give them more assets, I would love to see if we can renegotiate that down to be a parity with Ernest Partners by 5 basis points. I don't know if they will. I know you guys had those discussions when you guys came on board, but they've never come back and asked us for more money. And so Ernest Partners have come back to us. But I would love to see if they can do that. Well done.
Okay. Ernest Partners came in 2008 and
Yep.
Manulife in 1987.
Wow.
Yeah. So
Lord have mercy. They've been here since as long as I graduated high school. Right. So they've never come in to talk to us ever. So I would like to allocate it not so much equally split, but on where you see that we're going to get the performance and the stylistic returns. They're not identical. I believe Manulife is a little more quantitative than Ernest Partners.
Yeah.
I can't recall. But I would really like to see you look at the allocation over the next 9 months, how to allocate that. Because how much does Ernest Partners have?
Ernest has, let me look at my last report. Ernest Partners has. Hold on a second.
Did just give them an additional 10 million earlier this year.
Yeah, we just gave them some more money.
21 million as of the last report.
Manulife, we gave 21 million? We
No,
gave-
No, that's the total that Ernest has. Manulife has
Point.
36 million.
Okay, yeah, and if you look for the committee with the slide above, you look at, 3 years of we've had a very tough fixed income market, the last 3 years with COVID, but look at 5 years, right? We're pretty much Manulife and Ernest Partners. We're still very positive. We're still positive in 7 years. We're, Manulife obviously has given us a little more return over 10 years. And is that 6? I can't see is that 6.23 or is that, it's not 1.023? Ooh, my eyes are getting,
You're talking about the what?
oh, it's 6.23. I thought I was like, how did they go to 0.23? 5.78. So they've been pretty much in the same range. Looks like Manulife has given us more return for our money over that's standard deviations. I'm sorry.
The 10 years.
Yeah, the 10 years looks good.
Yeah.
So these have been very good performing managers for us. I don't know what since inception, but it really doesn't matter. They've been pretty good over the last 10 years. And we've had some volatility, some serious volatility, but in the last 3 years, it's been on the fixed income side. So I'm going to leave it at that and let other managers, let other trustees see if they have any questions.
Yeah, I'm gonna tell you, since inception, since 1987, Manulife has returned 6.28 compared to the index at 5.44. And Ernest Partners came in, like I said, in 2008 at 3.47 versus 2.76. So they both have return in excess of the benchmark net of fees. So the current managers you have, they're doing the job that they're supposed to do. So, it's the pleasure of the board what you'd like to do, but our suggestion was that you reallocate amongst your current core managers. And like that being said, Exponent still has a over $50 million portfolio in your international portion of the fund. So.
Right. And in the discussion we had the other day with Louis and I had with Tina came in. She's the founder of Exponents. She came in earlier this week. We did, I would like to see a little more return on the opportunistic fixed income from them to be able to down the road see if we can allocate small amounts to them on the fixed income side. But right now, if they're winding that down, I would wind it down and reallocate it to the 2 managers that we currently have. So I do support the recommendation that ANCO is putting before us. But I'll leave it open to dialogue to the rest of the trustees to see if they have any questions.
Okay, so my question is, should we divide the 11 million in half to 5.5 million to both firms, both managers?
That's what Christina was saying, is that she wanted to wait and see if Manulife would come down on their fee and see how they both perform, to not necessarily split it down the middle, but allocate it depending on what they come back to us with. Am I correct in what I just restated, Christina? Is she still on? I believe that's what her point was.
Right.
Okay.
That's what it sounded like to me too.
I'm sorry. Yep. I'm flexible, Bobby, if you want to, whatever, if you make a recommendation, I'm okay with it. But I'm flexible.
But
we
first-
can't go wrong.
But at first you said you want to see Manulife come down on their fee. So how long will we have to wait to see if they come down?
We can approve it. Again, they may or may not, but if they do, right? I mean, if we agree to an allocation, it is what it is. But I would like to see if Welda can say like, hey, they're gonna give you more money and you want to drop your basis. But if they say yes, we're golden. If they say no, it's okay, right? You gotta ask or you gotta ask. Or you'll never know if it was a yes or a no.
Yeah, and if I'm not mistaken, they are the graduated scale. I have to look at the graduated scale and see what's the break point, where they would come down, but I don't think we're close to the break. I want to say it's 50 million.
Yeah, and we've been with them forever, so maybe they'll give us a little wiggle room to get another 5.5 million.
We can ask them.
Yeah, but I would recommend the recommendation, Bobby, whatever you recommend.
Okay, all right, thank you. Okay.
Question. So is it Manulife?
Yes,
All right. They have higher percentage returns over the period than the other company. Is that right?
correct.
So what, I'm sorry, I just came in late. I had trouble getting in, but so what is the ANCO recommendation? And Chris and Bobby, what are you all saying?
I think we had originally said split it in half. But I think Christina's question was if we give Manulife more money, if they would give us a fee concession, we could ask for a fee concession. I don't know.
Okay.
My recommendation is not based on whether they give us a fee exception or not. We can agree to whatever the split is, but still ask Welda to ask for the fee concession.
Okay. So, and the other company is what again?
Ernest Partners.
Ernest Partners.
Okay. So you want to split it 50-50, but you're asking for Manulife to go down on their fees. Their fees are a little higher than everybody else, but then they outperform everybody else. Is that right?
That is true.
Yeah, that is true. We are getting more than 5 basis points from them compared to Ernest Partners. But Ernest Partners, Louis, you missed it, was 25 and Manulife is 30.
Okay, so then why are we splitting? Why don't we just give Manulife the whole thing and you all just tell me the yeses and the nos to that?
The whole thing is 11 million, Louis. So that's what you're talking about?
Oh, no, I understand. I didn't know the exact amount. Thanks, Bobby. But I think why are we splitting it if Manulife has a higher return on our investment than the other company? Why don't we just get whole 11?
So that's what Louis, you may have missed it, that I didn't,
I did.
what I said is, let's allocate the money based on the returns of performance. And we went through the performance, and obviously you'll see that Manulife has been a little more positive. And then I said, but I'd like to get a concession if we give them more money. So again, I am flexible. Welda, what are you and Jeff thinking here?
Jeff, you want to weigh in? What do we didn't.
Yeah, I guess there's a couple of things I want to throw into the discussion here regarding the two managers and the structure. And first off, it's, and Gwelda will go through this when she takes a look at the flash report, but our target allocation to core fixed income is 10% in total. However, we haven't really targeted, by policy, we don't really target how much would go to each manager. Now, theoretically, we would say, because we think they're good diversifiers of each other, and on a long-term basis, while yes, the numbers we look at as of today say Manulife's had a better return, and for a 10-year period, it's still kind of marginal, 1.8% versus 1.4. But as we look forward, we expect you're probably getting something similar from the two managers. And now, as we've gone through this interest rate environment where rates are a lot higher now, we're going to be expecting better returns from these managers. And I think the next couple of quarters will sort of tell us how each of these managers operates in these environments. So I guess I'll start there and then say we are underweight in total to core. So that would be a reason why we want to push the money up that way. as far as having the two managers being sort of evenly split on a go-forward basis, they're not. So we know Manulife has more money at this point. So I guess that would, again, Lewis, I see where you're coming from. It's the better manager. Why wouldn't we give it all?
Exactly.
Again, I think we sort of look at it from a forward-looking basis of we would expect as we go forward, they probably perform a little bit more evenly and still continue to average each other out in a portfolio. I guess another thing too is if we, and again, it's not going to be very meaningful on these charts, but Sue, can you flip forward a few pages, because we have an upside downside chart. Let's go forward a couple more pages. This is the risk reward. So so this is the 5-year. And again, how to read this chart. I know it's tough with this being up on the screen and in being small here, but if the blue lines are those crosshairs, think of that as the index performance, and then those quadrants being how each of these managers performs relative to the index over time. So if you are to the left of the vertical blue line, that means when the index is down, the manager's actually not down as much, so they protect capital on the downside. Then that horizontal blue line, that's the upside. So when the market is up, if you are above that line, which all of these managers are, which is fantastic, it means when the market's up, your managers are actually up more than the market. So being in that top left quadrant is the best place to be, because you're outperforming when the markets are up and you're not performing as bad when the markets are down. So that's always the place you want to be. Again, you see they all kind of stack up a little bit, but Sue, if you back up one page to the 3-year, and again, I think this is kind of telling, just because the last 3 years have been very interesting with fixed income and interest rates rising, that Earnest has been the better protector. Again, it's not, we're not out a bunch of different squares on that it really stands out, but on a marginal basis, Earnest has done a little bit of a better job in this rising rate environment that we've faced of protecting capital. So that's we kind of look at that and just say that's why it's a good diversifier. That's when we think long term, when we look out after 5, 10, 20 years, and hopefully we're going to hold these portfolio managers for a very long time. And we know we've had some that have been here for a very long time and have done a good job. That's why we think of that weighting scheme of it probably makes more sense to be closer to equal than not amongst the two managers.
And we're going to go through the flash report in a little while, and what Jeff was just saying with the rising interest rate environment, you will see that Earnest Partners in the more near term has actually outperformed.
Okay, so let me throw an additional wrench into the works now of this discussion, and Christina, you sort of brought it up before when you said, well, let's kind of evaluate things over the next couple of months. And from our conversations with Exponence, because of some of the positions that are in this existing portfolio, and also having, well, 1 or 2 larger investors in this portfolio that they have to wind down as well in a conservative fashion to keep everybody whole, this doesn't happen very fast. So what we were told is this could potentially be a 9-month process of them trying to liquidate all these holdings. So we would be getting some back in dribs and drabs over the next several months. So also something just for us to think in mind from, or keep in mind from a timing perspective. And again, depending on what the markets do from month to month, we might have more of a differential. So maybe Earnest has some outperformance and their allocation increases a little bit. So it probably ends up being a little bit of a moving target of how much we're giving them as we get the money back. So, but that's probably why it makes sense right now to just think about how we would split it up. So you sort of have to weigh that. Yes, let's maybe Manulife right now is overweight, but let's still give them more money because they have been the better manager. But let's also look forward and think about capital protection and downside environments. And that's why we would want to think about giving some to Earnest as well.
And I guess what also could balance it out is that Manulife's fees are higher than the other fees. Is that correct? Are they substantially higher?
5 basis points. So,
Is that considered
0.05%, right?
is that considered kind of like substantial, or is it
not really.
not
It's-
really?
It's not a major deal breaker, but if you multiply that times, $11 million, right?
Right.
It's not that, but more, yeah. At if it were 10 to 15 basis points, it would be significant.
I got you.
but-
So
but
5.
five is not, I'm not gonna
Okay.
say significant, but it's 5 basis points.
Okay, I got you.
Right.
All right. So what Bobby said is accurate and Christina. We'll look and see, and then we'll make a decision, but 50-50 is probably the better way to go. Is that right?
Yes.
That would be our recommendation at this point.
Okay. Well, I'm with them. I'm with whatever they say, because Bobby and Christina run this show anyway.
Are there any other comments from any other trustees? Or questions?
I'll just jump in really quick too, again, because we do have it in our quarterly report, on the fee page, the breakdown, and it looks like it's the Manulife's current fee that we're paying is good up to 50 million, and then once we get above 50 million, then then it goes down to 0.25% on
Okay.
anything above the 50 million. But again, if that's been a structure that's been in place for a while, there's always the ability for us to address it with them and say, we are looking at more money. We'd love a break on fees. So
Squeeze them for another 1 or 2 basis points, Jeff.
hey, anything matters. Anything matters.
Right?
Man.
We can ask. We can definitely ask.
It never, my grandpa used to say, closed mouths don't get fed.
That's
Right.
right.
Mhm. Doris, you have any questions, Shanice? Okay, I see.
Not right now.
Okay. Sue, how do you want to proceed?
If the trustees want to make a motion just to, I guess, liquidate the portfolio, then, we wouldn't have to really get into allocating the funds later because it's going to take some time. But if we want to get started on the process, we probably want to get, at least that motion made, and then that would be, have to be approved at the June board meeting.
Okay, do you have something written up for us?
I do not. I wasn't sure exactly what was going to happen, so I do not have anything.
So can I get a motion to approve the liquidation of the Exponents fixed income portfolio?
So moved.
I make a motion to
Liquidate.
I make a motion to liquidate the Exponents fixed income portfolio.
Albert, you kind of late. You have to second it, not.
She already presented it, Al. You did just a second.
I thought she said, "Can I get somebody to make one?"
She did say
Oh.
that. What does that mean?
You
Right.
know what? You got to
Oh.
second it because Shanice
Sue,
made
are
the
we-
motion.
So are we in line, or do we need to do it all over again?
Shanice made the motion. Albert, you just have to second it.
Okay.
I second that motion.
Is there any discussion? All those in favor?
Aye.
Aye.
The roll-
Those opposed?
Yeah. A roll call, don't we?
Yeah, I'll do a roll call.
I was just gonna say, Sue, can you do a roll call, Louis?
No, it took words right out of your mouth. Right.
Christina Bennett,
Yes.
Louis Cross,
Yes.
Shanice Johnson,
Yes.
Donna Jones,
Yes.
Martell Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
and Doris Walker.
Yes.
All right, so we have 8. The motion carries.
Okay.
Motion carries. Thank you, Sue. Next on the agenda, Gwilda or Jeff?
It's the flash report.
Great.
Are we gonna do flash or custodian?
If you're custodian, that may take a little bit longer. The flash report, we're gonna give you a full in-depth report next month, which will be the first quarter. But so Jeff, you want to go ahead and do the custody discussion?
Sounds good. Sue, if you want to pull that up.
Yep.
Okay, so this may be dry and not the most exciting stuff out there, and I wanted to keep this at a high level and digestible for everyone. So and hopefully we'll get in at least 30 minutes so it can qualify towards your education requirements on this. So but this is timely just to talk about the custodian, because we do have it on the agenda, and we know it's been a while since the systems custodian has been reviewed. And so if everybody doesn't know, because again, this is not as exciting and sexy as talking about, exponents and how they make a lot of money for us and things in the portfolio, but it's an equally, certainly equally important role in the system and the security of the system, and that's the custodian. So US Bank is the current custodian, and Sue can certainly jump in with more comments, because she, Sue and Sue's staff will be the group that probably gets touched by US Bank the most as far as operations and what they do. So, but it's a service provider. You pay them a fee, and they safeguard the assets, and it's much like all of your other service providers in the system. You have to evaluate them to be fiduciarily sound and understand what they offer and the services, and are they fair for the fee that they're charging, and is all of that in line, and is it a good group that offers this service? So those are all things that go into this potential request for proposal that we're going to talk about. But again, this sort of gives us the basis to think about why we're even doing it. So Sue, if you want to flip forward to the next page. So this is, very, very simple. Oh, go back one. There we go. What is a custodian? What do they do? Because again, it's not something we talk about a lot. We have quarterly reports, and we're always looking at investment manager performance and a lot of metrics and things like that of what's actually making the system money, but we don't often talk about a custodian unless, of course, Sue says, hey, we're trying to get some information from the custodian, or we're not able to get some payments out because of the custodian, or this and that. So again, we just don't hear about it all that often. But again, for the system, it's US Bank, and if you start at the top, these are all of the assets of the system, and they go down into the custodian. And we thought about laying this out a little bit differently, because really you could take that box that we have that's shaded a little differently, the asset safekeeping, and sort of wrap that around everything. Because really, when you think about the custodian, what their primary role is, that's what it is. It's to safekeep all of the assets. And so why do we do that, or why do we have the custodian? Essentially, we have all sorts of different money managers that are managing the assets, but from a safeguard perspective, if we just said, hey, Exponents, go ahead and we're sending you a check for the money, and you sort of keep it in your safe deposit box or under your mattress or wherever you want to put it, or your brokerage account, and then just tell us how it's doing. Well, that's not really a good safeguard, because now we're beholden to what Exponents is telling us. So this is really a good third-party check that says we actually hold the assets. We allow Exponents or TCW or any of the managers to reach in, or to reach into the account and tell us how we want to trade securities, but they don't hold them. We hold them. We have a safe separation of these assets, and so that's very important from that perspective, to make sure we have everything separated. So again, we have a number of different services that custodians do, and there's maybe not so much rhyme or reason to how we have these laid out, but we tried to put the ones at the top that are probably more prevalent, but certainly all of these services can and are utilized. But cash management, so for each of the accounts that the system has with all of the managers, sometimes money is coming in and is not invested right away by the manager, so they don't go out and buy a security right away. If the money is sitting overnight, well, it has to sit in a cash management account, so in a money market fund or some sort of vehicle that if you go back a couple of quarters, you weren't getting a whole lot of money there. But as interest rates have gone up, that's become a more important function, that you're in a good vehicle that actually is getting us some return while the investment manager is not investing it. So the custodians offer that through their vehicles. The trade execution, settlement and reconciliation. So again, investment managers are going out and making the trades, but now someone has to come back and say, okay, here's the money for the security that you just bought, for stock XYZ that you just bought. Take the money and now give us the confirmation that it's been purchased. And then it has to settle to say, okay, after a day or so, it is now settled. You own the security. So again, the custodian is the group that's confirming that you now own the security and now safeguards that. And then the reconciliation, because again, you have managers that report what they have on their end. So they buy a security and they have a broker that tells them what they paid for it, and then how much their pricing service tells you that the stock XYZ is worth. And then the custodian has their own system, usually an independent system that says, okay, we have 20,000 shares of Apple, and today, as of the end of the day, here's the price of Apple, and based on our pricing service, and so this is what it's worth, and here's your value. And so again, it's a third-party check, because the manager might tell us a value that's different from what the custodian service is coming up with. And that's where reconciliation comes in, because if the custodian sees that there's major differences, they have to go through it and find out why. Is there an issue with the pricing service, and why are we not in sync? So again, just another check and balance to understand that we have information coming from a manager and we want to double check that information. So a very valuable service. Again, securities pricing all the way to the right at the top, that goes hand in hand again with what we just talked about. Independent pricing of all of the securities that are held in custody to come up with valuations. And that sort of brings us down to the second line, which is the consolidated reporting and accounting. So Sue and ANCO gets a whole lot of statements on a monthly basis from US Bank that has all of these valuations, that lists all of the different securities and gives us values, tells you how much you paid for them, tells you how much they're worth today. And it's a whole lot of data, but at the end of the day, it's stuff that we need for accounting to prove that the system's assets, that box all the way up at the top, are there and they're real, and we have them and they're tangible. And so this is that perfect check to understand why. And again, from why we say consolidated is that we have a bunch of managers doing a bunch of different things, but the custodian can bring that all together in a very meaningful report that tells us a very uniform set of information on all of these different investment managers, the underlying securities that they hold, and what that all means. So again, very important function, the reporting and accounting function. Income collection, again, there's a lot of securities out there, whether it's if it's a stock that might pay dividends, well, those dividends have to get collected and brought into the account. So that's something the custodian does. Or a fixed income security that pays a coupon on a semi-monthly basis, or however often they pay their coupon interest. Again, that comes out in the form of cash and has to get collected and accounted for. Your custodian is responsible for that. Corporate actions, stocks can go through all sorts of different items in their life cycles, from mergers and acquisitions to spin-offs and all sorts of things that might result in complicated math of, well, you had 5 shares of Apple and all of a sudden they did a split. Now you have 10 shares of Apple, or or they're spinning off another unit into another security. And so these are all things, again, that have complex pricing activity behind it. And so your custodian is responsible for understanding how all that works and tracking it again. And let's say if Apple has a division, they spin it off to another company. Well, you still own it. You still have ownership in that, and it has to be tracked. So maybe it's no longer Apple, but it's another security that's spit off. They need to account for that, and you need to understand how that works and how many shares you got of this new company. So that, again, your custodian will do that with their corporate actions, activity, and tracking. Securities lending. This is one that not everyone uses. Sue, is the system currently doing securities lending through U.S. Bank?
We are.
Okay. And so what securities lending is, again, because U.S. Bank is holding or safeguarding all of your securities and your stocks as they sit there, what you have the ability to do is, what you all have the ability to do and you are doing is actually lend out your securities. And what that means is there's groups out there that actually will short a stock. So it means they borrow it in the hopes that the value of that stock will go down, and then they can go out into the market and buy it back at a lower price and then pay it back. So in order for them to do that, they have to have stocks to borrow. So they do that through these securities lending programs. So why is that a benefit for the system? Well, there's a price to that. So when you're loaning that out, there's an actual interest rate. So for however long they're borrowing that security and whatever amount that is, you're getting paid interest on that amount while it's out for loan. So that's the benefit. Now, again, if we look over the past couple of years when interest rates were so low, the benefit wasn't so big. But now as interest rates have gone up quite a bit, and we expect they'll stay elevated for the foreseeable future, there's actually much more meaningful money in the securities lending. So again, just another value added benefit of having your securities all consolidated in one place with a good institution that they're part of these loan programs. So proxy voting, securities class action. Again, I know we've talked about this in previous meetings. In particular, I know we talked about class actions and settlements, and I know we looked at firms that were helping out with this overseas. But again, for anything in particular that's here in the U.S. and even internationally, your custodian should be looking at, dealing with the proxy votes if your investment managers aren't doing that. However, we've tasked all of the investment managers that they will actually be voting the proxies. If an investment manager isn't, that's a service that you can certainly utilize a custodian for. And then again, class action. So a lot of stocks on an ongoing basis might have sort of class action litigation going on, and depending on how those class actions are resolved, the owners of the stock might be due a settlement. And so again, it's the custodian's job to understand if there has been a class action, if there's a settlement, and if there's money due to an investor based on a settlement that is collected. So again, that's another service that the custodian is offering. And then tax support, reclamation, and again, this is an important one because you are the system is a tax exempt entity, and so you shouldn't be paying taxes, but there are certain situations where you might end up paying taxes, and in an international stock, or even in situations where with some certain private investments where you might end up having to temporarily pay taxes. Well, there is a process to say, yes, we did pay some taxes for this transaction, but we are a tax exempt entity. We need to go through the process to make sure we reclaim those taxes because we didn't have to pay them. So again, that's a process that a custodian will support. So not a completely exhaustive list. There's other smaller items that a lot of custodians also can provide and add value with, but these are really the major ones. So I'll pause there and see if there's any questions. Okay, Sue, why don't we flip forward? Okay, so again, as I mentioned before, can be kind of dry, not stuff we pay a lot of attention to, but nonetheless, this monitoring your custodian, it's a fiduciary responsibility. So let's think about some of the fiduciary considerations here. And I already mentioned this on the previous slide, that from a fiduciary standpoint, this is good to have this custodian in the mix. It serves as a good check and balance for you. And again, from our standpoint as investment consultants, and from Sue's standpoint, and putting together reports and annual reports and statements, and having things that auditors like, custodians can be very helpful, because they're giving us those values that help us serve as that overall check and balance. So point number two, and this is sort of why we're going through this primer right now, it is a good idea to periodically review your custodial services and your fees and what's being offered, and making sure all of that is in line with industry standards, and to make sure you're getting the best services for the money that's being spent. So that's why we're talking about doing an RFP. We think it's a good idea, and that's what we're in the process of working on right now. So and I underline it here too, because again, we sort of think about all the stuff that gets done in the background, and we report back to the trustees. But at the end of the day, there's a lot of moving pieces. There's a lot of documentation behind it, and it's important just to maintain that documentation, because if regulators come in and start asking questions and looking for documents, we just want to make sure that everything was properly documented, and from a procedural standpoint. And again, that's a lot of that heavy lifting will certainly come to us, but that's something that we're sticklers on. So we have formats that we use for requesting the information, and certainly we'll work with Sue and staff to make sure we're all on the same page with what that type of document needs to look like. But then from receiving responses, to make sure we keep all of that on file, and then summarizing all of that to something that's digestible for everyone, to say, okay, let's apples to apples, the different custodians that we're looking at, and how did we choose the one that we ultimately went with, what was the pricing, what were the services, and checking a lot of boxes. So again, just having a good report, which again, we will certainly assist with and maintain, but to have that proper documentation of, this is how we reviewed them, this is how we selected them. So fee schedules, I'll spend a little bit of time on it, because they still vary. So again, the world of custody has been around forever, but we've probably started to get a lot closer to having more uniformity amongst pricing, but there can still be a lot of things that vary. So some custodians might charge an asset-based fee. Some will charge per account. So if you have 30, 40 different managers, different accounts, they might charge per each of those accounts. And there can also be transaction fees involved. So the one thing, and again, this is not a good or a bad, or you have to do it, you don't have to do it, but this is one thing that the system does do. You have an account for every manager, whether it's a separately managed account or a commingled fund. Again, we know auditors like that quite a bit. I know Sue probably likes that quite a bit too. But from the standpoint of any commingled fund or mutual fund, they actually have their own separate custodian for all of the underlying securities. So just to understand that when US Bank, we may utilize them to trade in and out of mutual funds, and they're going to track all of the mutual fund holdings and the different commingled fund holdings and give us valuations, but those are only really line items. They don't hold all of the underlying securities. So that's just something to understand from a differentiation standpoint. They do hold all of the stocks and all of the bonds for your separate account managers. Why I bring that up is just when it comes down to pricing, that if they're doing, whether it's asset-based pricing or a per account pricing, you will be paying for things that they don't actually have custody of. So again, not saying that's a good or bad thing. I think from a belt and suspenders standpoint, and things that are good fiduciary guideposts, that it's good to have them. I would tell you that where I tend to differ on that is when I have smaller clients that maybe only have mutual funds, and they don't need to be charged at an asset-based level, that will probably be more sticklers of saying, hey, we don't need the line item for a real estate fund or for a commingled fund, because we can track it, we can get the information, and we can sort of help to keep everything trued up there. But again, as you go up in size and you start to get to the level of where the system is, it makes good fiduciary sense to have the structure that you all have. So affiliated business units, that's the next group, and you see this a lot with most custodians, that they might be affiliated with asset management groups. So Mellon is a good example. The system currently has some index and funds investments through Mellon. Mellon is not the system's custodian, but they are a custodian, and it is someone we probably want to include in the RFP process. But again, I think even US Bank has products that they offer. I'm not sure what they have on an index level, but they have a lot of different actively managed products that they offer. So one thing that always does come up, and I'm sure we will run into it in this RFP process, is they'll say, well, we can, our standard custodial fee schedule is 5 basis points on all assets, but if you use certain US Bank products, or if you use Mellon products, or if you use Northern Trust products, we'll actually bring that price down to 3 basis points. So it's not unusual for that to be pitched. I think, again, from a fiduciary standpoint, how we always look at it is to say, try and keep those two functions as separate as possible. So for instance, we've already opined on the Mellon products and said they're good, they're low cost, and we recommend them for your investment. So having already made that decision, now if we came back and said Mellon is the best cost provider and they can do everything you need, and they might give you a little bit of a break on custody because you currently have some products, then you can certainly evaluate it from that perspective. But what we will caution against, and I know we'll definitely take a hard line on it, if US Bank comes back to us and says, well, we know you don't have any US Bank product in your portfolio, but we can give you a great deal on custody if you can invest in this suite of products over here. So that's just something that we would draw the line on and say, don't let the investment manager tail wag the custody dog, if I can.
I was going to say the reason they're offering these investment products is custody is such a low margin business that they're trying to get some more fees. So a lot of them will offer index funds to help to increase their fees. I'll get some more fees because custody does not pay that much.
Right. Well said. Well said. So the next point is with respect to fiduciary responsibility. So all of your investment managers, because they really have a whole lot of discretion with respect to how they're investing your money, we require them to accept fiduciary responsibility. Custodians are a little bit different. A lot of custodians take the stance that anything that they are going to do for the system is really at the system's direction. So anytime they have to move money, it has to be by a direction letter from an authorized signer. And certainly anything they do from the regards of how an investment manager operates, same thing. It's investment manager is a fiduciary. They're directing a custodian to settle a trade. It's coming from a fiduciary. So they're basically saying if they have no discretionary authority to move assets or control assets, that they're not really a fiduciary. So again, just something to think about, because when we send out RFPs, generally one of the questions there will be, do you take fiduciary responsibility? And you're probably going to get a split on that. And I would say actually the larger percentage of custodians saying they don't accept fiduciary responsibility in writing. You might get a few that do. I would just tell you that it's probably more standard than not. So it's not a deal breaker for us to say, hey, if custodian XYZ said they're not going to act as a fiduciary in writing, that we would have to kick them out. So again, that's just something to understand about the construct. And the final bullet here is that, and this one's
Wait,
pretty.
Jeff, I have a question.
Sure.
Why would they not accept it?
Well, because essentially they're saying that they have no discretionary authority to move assets, and so that's as far as how fiduciaries are sort of defined. That's going to fall into that category. And I would tell you, from their standpoint, it really comes down to, I think it's going to come down to different levels of insurance. So they'll have all sorts of insurance that covers your assets from a custody standpoint. But what they won't have is, they won't carry certain coverages in their insurance that says, yes, we're going to add tens of millions more dollars of coverage to you because we're acting as a fiduciary. So I think from a cost and fiscal standpoint, they just don't do that. So
I guess maybe a better thing is to say they act at ours or our investment manager's direction.
correct.
So they never make decisions on their own that's going to be best for our plan, because they're acting on direction.
Correct.
So that's why they wouldn't accept fiduciary, because they're kind of like, I'm trying to live as an example, right? If you have a broker, you tell, and you are making the decisions, you tell them what to buy. I'm buying Apple. And so they're saying, okay, I'm just going to execute what you told me to do. So that's why they wouldn't accept it, because they're taking direction from us. We give direction to the investment managers, and the investment managers tell the custodians what to do. And they're just the holder, the keeper of our assets, to make sure that it's like third party. Our managers don't hold assets. We don't hold assets. It's kind of a holding place. And then they offer all these other different services.
Correct. That's a good summary, Christina. And again, maybe to sort of tie it into our earlier discussion today too, maybe a good example would be, okay, we have $11 million that's going to come back from Exponent, so that'll hit an account in cash. We are going to have to tell the custodian what to do with that. So when the money comes in, we will have to send them direction that says, send that money over to Earnest so they can invest it. So they don't have the discretion to say, oh, if any money comes in, like $11 million, we are going to invest it according to your policy. They can't, and they won't do that. So, but certainly what we do want to make sure is that they carry a good level of errors and omissions insurance, because in cases where something like that would happen, again, it shouldn't, and custodians just don't do it, but that's something we certainly want to pay attention to.
The only time that they invest money is as cash, so that
Correct.
they're idle, so that it earns interest. When you have cash come in, it will automatically sweep into a cash vehicle that will earn interest on it.
Correct. And that also comes through pre-existing standing direction when you sign a custody agreement and forms that say, this is what you do with existing cash, this is where you sweep it to. So even that sort of comes early on from a level of direction from a fiduciary. So the bottom one, this is important, and this is sort of what makes most custodians a custodian, but that they keep the assets of your plan separate from all of their other business. So again, you'll see as we talk more about this RFP in the different banks, you'll notice a lot of custodians also have other banking businesses. They're the banks that you all have heard of, Commerce and Regions and PNC and the big banks that do all sorts of other banking business. They take in deposits from investors, they make loans, and again have all of these investment management operations that Gwilda and I just spoke about. What you want to make sure is that whatever's going on with those businesses has nothing to do with your assets and the safekeeping of your assets. So again, that separation is very important, and that's called qualified custody. And again, we just should never run into a situation where any custodian comes in and says, well, we're not a qualified custodian. We are actually commingling all of your assets with the rest of our business. So again, we just would never expect to see that with anyone we deal with in institutional custody, but an important item for everyone to understand.
Yeah, so basically it's kind of like us having our own safe deposit box.
Correct.
Our assets are in our own box. They don't, even though we're in a big room with everybody else, we have our own box and they do what we tell them to do in that box.
Correct. And the bank has no ability to say, well, we're a little bit short today. We've got a loan that we have to make, so we're gonna dip into to the system's safe deposit box here, but we'll pay it back. They just have zero ability to do that. Okay, why don't we flip forward? So let's talk a little bit about the RFP process. Again, we're not going to go in depth because the forms that we send out, again, they can be pretty extensive. But I think this will give everybody just a good idea of the process from a timing perspective. So we're looking to put out an RFP either late this month or early next month. The short list that we have of who we would send this out to, it's a U.S. Bank, so that's the current custodian, BNY Mellon, Comerica, Commerce, Northern Trust, PNC, Regions, State Street, and UMB. So all of those should be names that everybody is familiar with. These are all very reputable, institutional quality custodians, and we've dealt with them in some form or fashion across our firm. So we're very familiar with all of them. I did put at the bottom there others at the request. So if there is other groups locally that anybody can think of or otherwise that they would like us to include in the process, we can certainly do that.
So Jeff, Wells Fargo, they,
Oh, Lord.
2022, they ended up selling their custodial services to Principal.
Yes.
And they are local here. And that's who we custody with for the city.
Okay.
And so they've done a pretty good job. And so I don't know if you've worked with them in the past.
We have. And so if you have a particular contact,
I do. I'll send it to you and to Gwalda.
Okay, because that way we'll just, whatever we're sending out can go directly to that person.
I have a question.
Sure.
Okay. Considering the issues with the smaller banks, regional banks and so forth and so on, why aren't we also going to consider Chase, Bank of America, Wells Fargo? Well, Chris said Wells Fargo doesn't deal with us anymore. Is that what you were saying, Chris? They don't deal with this particular line?
They sold their line of business back in early 2022.
All right. So then Chase, not Wells Fargo, Chase, Bank of America, and I'm trying to think of the last one. But anyway, the larger banks, I think there were 4 of the largest banks. Why wouldn't we also consider them in this process?
Right. We certainly could. Again, as we were sort of going through the short list, we number one just looked more of the ones that we deal with consistently. I can tell you, JP Morgan has been.
That's the other.
JP Morgan is Chase.
I'm sorry, Chase has usually been at the sort of the higher end of the cost spectrum. I know they're one of the groups, and State Street probably falls into this bucket too, but I think if we're doing State Street, certainly we can throw Chase into the mix. But State Street, US Bank, and BNY, a lot of them are now falling into this category of just saying, if you're not a multi-billion-dollar plan, we either don't want you or we're going to charge you a whole lot of money. So again, not to say if we want them to look at as a comparable and maybe they come back and surprise us. I just say more often than not, in a lot of the searches that we've done more recently, we've probably thrown them out on pricing. But again, we're happy to include anybody you want in this.
Well, no, I guess I need to be a little more educated in the process. In other words, I'm concerned, and I think I shared that with Sue and Christina at some point, that because of this issue with the bank in Silicon Valley and all that stuff,
Sure.
that regional banks and they're vulnerable because of some laws that Trump changed and so forth and so on, and they're not scrutinized as thoroughly as they had been in the past. That being said, I just felt that if we look at a larger bank, some of the four larger banks, then we're insulated. But I guess what you're saying is that's not the case, because if we don't have enough money to invest, to put into their pot, then they're going to charge higher fees to do the work. So you're saying that you feel comfortable with regional banks to do this. Is that right?
Well, and again, I want to go back because I think you have a valid concern, because it's certainly on the tip of everybody's tongue right now with these banks and these issues. But sort of a couple things to point out, and I know, and Sue can probably attest, and I know Guala will jump in too, that when it came to custody and some of these regional banks, that there were a lot of private equity firms and other groups that had sort of custody relationships with these banks. And that's where, when I mentioned before, the qualified custodian and having that separation of accounts, that's very important. So even when these regional banks fail, if these custody assets are properly separated, which they should be, and they were with all these regional banks that were involved, that it was insulated, there was no losses from that, and they were ported over to other banks that were able to take over that service. So now again, there's certainly a headache in it when it happens, because you have to move everything to a different bank, and it's got to be repapered, and there's also all sorts of hair that goes along with it. But at the end of the day, your assets were safeguarded, and you didn't lose anything from it. So that's where that separation is very important. And again, but I think you also made a good point of, certainly we do want to pay attention to if they're just so big and they don't want to take on certain levels of below a certain asset size, that they can be expensive. But again, I think that's a critical part of this process, is that we will see where everyone is pricing, where they're drawing the line on minimums. And then also, I think what's going to be important to your concern here is just comparing a lot of the different safeguards and insurance coverages that each of these banks have. So comparatively, we can see it. So there might be a couple in here that fall closer to that regional bank spectrum, that when we get a response from them, we say, hey, we don't like they don't have enough insurance coverage for us, or they don't have enough business, they're not safeguarded enough, and we can throw them out. So I think at the end of the day, putting more data points, if we want to add more, we can certainly do it. It gives us more comparables.
Well, then what I would like to add is Bank of America, Morgan Stanley was the other one, and Chase. And thanks, Chris, for letting me know about Wells Fargo, because that was going to be the fourth one. Although I'm really leery of some of Wells Fargo's practices, I'm glad they did sell off, because you hear me all the time about some foolishness. But anyway, Go ahead, Chris.
So Louis, I'll send them a contact for, again, I told you I have to do an RFP for a custody as well. So I've been collecting some names, and we are peanuts compared to our fund, right?
Yes.
So I'll give them a contact for Chase. I'll give them a contact for Bank of America locally, and Principal.
One of the things that we're going to consider also is our analyst within ANCO. The custody bank is the source that we go to in order to calculate the performance. So it's really important that their information comes over in a timely and accurate fashion. So we're also going to be looking at that and talking with our analysts that work on the accounts, and said, okay, who have you dealt with where you had difficulty or stale pricing? So those are things we also consider, because that can be problematic, because bad data in comes bad data out. We can't calculate performance properly if we're getting stale data.
I got you.
And I'm new here, but I want to ask, is Edward Jones a consideration here? No?
No, they're a brokerage firm.
Brokerage firm.
Okay.
They're a brokerage firm, so they don't do institutional management.
And,
custody.
say it again, I'm sorry,
or custody.
or custody. Okay, that's what I wanted to make sure. And neither does city or Stiefel, right?
Stiefel does more brokerage. And they're going into wealth management, but I don't believe that Stiefel does custody work,
Okay,
but I could be wrong. I don't know anybody. I don't think so. I don't think
believe they do.
custody. I don't think they do either.
well, Jeff, if you don't know, then no.
Yeah, and again, US Bank, Mellon, State Street, those are your bigger ones,
Mhm.
right? I'm not familiar with Co-America Commerce. Your UMB, your Regions, and your PNC are going to be local. Northern Trust has a very small wealth management department here, but not much else. But Northern Trust is a good custodian. Commerce is out of Kansas City. Regions down in Alabama. State Street is huge. It's on the East Coast. Boston, I believe. Am I correct, Jeff?
Correct.
And so you've got to, US Bank, while we've never put them up for bid, they're not local. They never have been when it comes to custody. I don't know where they custody out of. What's their office?
Minneapolis, I believe.
I was gonna say, yeah, we had a small one here, a small trust, and first they acquired First Star, and then moved. First Star was up north. So that's a big list. Some of these may respond based on our size to say thanks, but no thanks, right?
Okay.
We can send it to the contacts. They can choose to say yes or no. Yeah, I'm thinking that State Street's going to say this is a little too small for them, but they could surprise us, right? The Bank of Americas could say it's just too small, but they could surprise us.
Okay. And lastly, just a couple of other ones, just to get some understanding. Enterprise Bank and Central Bank.
Enterprise does not do custody.
Okay, and how about Central?
If Enterprise doesn't, Central would not. And those are, I don't want to disparage them, but those are a lot smaller than even your Commerce.
I see. Okay, that's what I'm saying. I'm getting education on this because I don't know the
They
banking.
make custody on a very smaller scale.
Mhm.
Oh, I'm sorry, Shanice, you're on mute. But for our asset size, I'm not sure. Enterprise, I could Google it really quick to see if they do, but I don't think they do custody work.
Okay.
I know I used to work there, and I know we didn't do custody work when I worked there because they have a trust department, right? So they're not big brokerage firms. They're not. And we used to use Schwab to hold our assets back then. So, but maybe you can tell me, Jeff.
No, not that I'm aware of. Not that I'm aware of.
Okay.
So,
All right then. Well, we'll just move forward with it and see what we got. Seems like it's a lot of moving parts with this particular one. And Sue told me that when we talked earlier about that. It takes a lot of planning to if we go to a different bank.
And I think that's why our former executive director didn't just chose not to move this to the forefront, because it is a lot of work to do the RFP in addition to the transfer of assets. The rationale was always it's going to cost us money. But it's our fiduciary responsibility to ensure that we're getting the best services out there. And performance is not an issue here. It is our fiduciary responsibility to go out. And I know that US Bank has had this over 30 plus years. So could be even longer. And so we don't know what the bells and whistles are. They've never come to us. They've never recommended to come back and say, hey, committee, we'd love to, show you these new whistles that we should institute in your plan. Now,
Mm.
those conversations could have occurred with the former executive director. They were just never brought to the board.
Okay.
So I'm not going to say they never have, because we've never been informed as a board of any nuances that have been implemented on our behalf by our custodian.
Okay.
So if we haven't gone to RFP in 30, 40 years, we don't know what's out there.
Yeah. Yeah, that's and Sue brought that to my attention shortly after she became the director, that, and I already knew that we had not taken a look at US Bank in a very long time. And I know Andrew, I think we used to rent from them when we were in the former Mercantile Tower for years and so forth. So almost like family, we've been with them so long. But I agree that we need to take a look and see what's out there and see what's offered.
So, Louis, you know why we rented from them, right?
Well, we didn't have a place, or something that I don't know.
No. So the problem is that if you look at the banking consolidations that have occurred in St. Louis over the last 30 years, right?
Okay.
They used to have smaller banks had these big, magnificent offices, and so as banks merged and consolidated, they had more space than they needed.
Okay.
So they rented to us so that we just filled their shortfall in their lease requirements. So we subleased, I would say, right?
Yeah.
So that tower used to be
Mercantile Tower.
Mercantile Tower, right? So it used to be Santerre. I'm not from St. Louis, but Santerre Bank, right? And Santerre had a huge trust department.
Right.
So that's why with the mergers over the last 30 years, it just happened that US Bank happened to have a branch in there, but it no longer became the US Bank Tower. So
I just remember that at that particular point in time, the rent was $25,000 a month, and I thought that was exorbitant. But everybody said that was the best that they could do at that time, and so that's why we landed there as well. So again, and that we're opening it up,
Right.
and let's see what we got.
Yep. Well, Jeff, I really like the snapshot that you've given us in the 4 to 6 pages. What's on the next page?
Okay, so everybody sees the timeline here, so we'll skip over that. But Sue, if you want to flip forward to the next page. So again, the forms that we sent out, the information we gather will be fairly extensive, but this at least gives us a high level of some of the key items that we would look at. So pricing, history of the organization, their institutional quality, critical mass of the assets that they custody, experience of a service team. That's always very important. As Gwelda had mentioned before, the reporting, timeliness of reporting, and making sure we get what we need in real time. Online access, that's always important. There still are some of these old line groups out there that continue to do nothing but paper statements, and to not be able to get what we need online in this day and age is a real challenge. Again, the timeliness, systems, backup, cybersecurity, those are all very key hot buttons. As I mentioned before, insurance coverage. So again, safekeeping assets is, certainly there is a risk behind that for everybody. It's someone else is holding our assets. So if something does happen, we want to make sure there's proper insurance coverage to secure us on that. Mutual fund trading platforms. Again, this is fairly standard now across most custodians, but just understanding that any mutual funds that we do look at and want to transact in, that they have the availability to transact that for us. Omnibus structures, that's sort of a thing that we look at personally that kind of helps us aggregate assets with other groups in the custodian, that gets us access to better levels for institutional pricing on funds. Again, at your size, it's probably not going to matter much regarding that structure. Cash management vehicles, again, something we will take a look at, because again, as interest rates have gone up and that becomes a more meaningful piece of where we get return if we're sitting in cash, we want to evaluate all the vehicles and make sure we're in the appropriate vehicles. Information sharing with auditors. Again, this is certainly important for Sue and her staff and group, because all of this information that can go out to auditors and needs to be requested from custodians, we need to make sure we're getting that they're cooperative, they're timely, and we're getting the proper information that we need. Regulatory compliance support. Again, that's something that pretty much every custodian should offer. Again, that sort of goes along with what we need to provide to auditors. Some of that goes hand in hand from regulatory compliance issue, foreign securities experience and operations. Again, you do have managers that are transacting in foreign securities. So just to make sure that they can appropriately custody those, collect the dividends they need to collect, deal with all of the whatever foreign transactions, corporate actions, proxy votes, everything else that goes on in a foreign jurisdiction that might be different from the US. So making sure there's expertise there. And then the private asset servicing capabilities. So again, with the level of different private equity, private debt, real estate funds that we have, and capital calls, distributions, and all the things that that we can require assistance for on moving that cash around, making sure that we have the proper custodian to make that happen. So high level items. And again, from a time frame perspective, we're sort of looking to get this, at least the front end of it, turned around fairly quick and sent out to not only these groups but the other custodians that you all mentioned, and get the process moving.
All right, Jeff.
Hopefully that was insightful and gives everybody a better understanding of what these groups do and how this RFP runs.
Jeff, nothing like an exciting custody conversation.
I warned everybody up front that this was not going to be the most exciting thing. So
let me tell you, I have to say today you got the short straw today, Gwilda. You were lucky.
Okay, no, we do have a couple things, and you all tell us how you want to do this. Like I said, we're going to go in depth on the performance in the next meeting, which is a quarterly meeting. I will just say that the fund was positive in the month of March, but not quite as positive as the policy index, about 1.2% versus 1.9 for the policy index. But something we need to close the gap on. Jeff did we did some additional research on SVP and wanted to know if y'all wanted to address that, because we're down to about 5 minutes within your meeting time.
5 minutes in, I'm on the East Coast, so it's dinner time.
All right, well, we're going to try and get you fed then. So SVP, if everybody remembers from the last conversation, there were a couple of outstanding items. I know one in particular was just the history that the system did have a previous investment. So we did go back to them to get a little bit more detail. And ultimately what we found out is that at the time that they were raising capital for the vehicle that the system was invested in, they were also raising money for another vehicle that was more, it had a wider scope, more diversified, was doing a different subset of strategies, probably more akin to the vehicle that we're recommending right now. But in any event, was probably just a victim of not the greatest timing and having this other follow-on vehicle. So they ended up having a lot more investor interest in that other vehicle relative to the one that the system previously committed to. So because their fundraising sort of slowed down, they just decided not to continue raising capital for that fund and returning the capital. So from the amount that they called, I believe it was $500,000, Gwilda,
Yes.
that was ultimately returned with a small profit. So there was no loss. I think at the end of the day, probably more of an administrative headache than anything of ramping up for an investment that ultimately they didn't fully call. So that was sort of I guess the rundown that we got. Now, as further follow up on that, we said, okay, well, now you're raising this next fund. Number one, are you raising any other funds at this time, any other competing funds where this might happen again? Also, after that situation and in the entire history of SVP, has there been any other situations where they were raising capital for a fund and this similar situation happened and they said no? So this is the only time that's really ever happened. All of their other vehicles have been fully subscribed, had full commitments, and fully drawn and turned around. As of this current vehicle, they already have close to $2 billion committed. So again, they're sort of full steam ahead with it. They feel like they're going to get quite a bit more in commitments, and this is a vehicle that will ultimately come out and go to fruition. And again, there's no other competing product that they have coming out that would sort of rob Peter to pay Paul on that type of situation. So again, that's sort of the assurance that they've given us that we wouldn't run into a similar situation. So that was one item. The second item that came up on SVP was just with respect to domicile. So as with all of these private structures, they generally have these very convoluted investment structures that have about 20 different entities, with the one entity that actually makes the investment generally being set up somewhere offshore, and then having different feeder funds, whether they're for offshore investors, U.S. taxable, U.S. tax exempt investors, and most of them generally have a Delaware, so a U.S. based feeder fund that a U.S. based investor that needs that kind of domicile needs. They initially didn't have such a vehicle. So they basically, from their tax advisors and attorneys, said, we have a vehicle that we're going to call an onshore vehicle, but it's still going to be a Cayman Island entity. And we went back to them, and Sue double checked with the systems council and just said that's sort of a deal breaker. We can't be in a non-US entity. So we went back to them and told them that was a deal breaker. They came back and said, well, we can create a Delaware feeder for this investment, and certainly for you all to invest. And I think if they do create it, other investors will look at it and say, we want to use that feeder as well. So ultimately, there will be a Delaware-based feeder, so you'll have that U.S. jurisdiction. If we sort of give them the go-ahead and say the investment is approved, then they would work up all of the docs and entity structure for that feeder, and that process probably takes about 30 days. So it's probably about 30 days till we have the documents. Then we could forward to Sue, and Sue can share with Fund Council for review. But I don't think that would put us off on at all from our timeline from what we really expected for investment. But ultimately, to get that process moving, we would look for at least some approval today at the committee level. So again, we'll come back and say we are recommending a $10 million investment into the SPV Opportunities Fund 2. Gwelda, did I miss anything there?
No, except for the fee update. That's it.
Okay, and that's we did have we had two different tables within that previous presentation that showed the fee of the structure. One of the tables was correct with a 1.75% management fee. Well, is that what it is? And then the other table had a number, I'm not sure where we pulled it from, but it had a 1.35% fee. That is not the correct fee. The table that had the 1.75%, that is the correct fee for the vehicle, and that's the management fee.
So we needed to close the loop today before we have them go back to them and tell them, yes, you are still interested in investing, and they will create the feeder fund, or no.
Except the ways I was trying to get dressed. So they will create a Delaware fund for us. Are we the only ones they're creating it for, or is it something that they already have investors that are asking for?
No, as of now, at least from what we've been told, they said their other public fund institutional investors have been committing to that onshore, the fund they're calling an onshore fund, but it's still a Cayman entity. They said that's where those institutions have been investing. So as of now, you all would be the first, but I suspect that as they continue to raise capital over the next several months, that if they're letting investors know that they now have a Delaware feeder, I suspect you're not going to be the only ones.
Okay, so Sue, do you have a motion for us or any other comments from the committee? I think from the last meeting, and let me recap, from the last meeting, we were recommending this. We were just waiting on that. Hey, was this the same fund from last time? That all got cleared away. We did not lose any money. We actually made a small profit off that investment. And were they aware that this was there before, or no? Is this a whole new team that didn't know about it?
No, they were. They had to look it up because it was a couple of years back. But I think once we sort of reminded them of it, they said, "Oh yes, we recall, and yes, here's what happened." So they walked us through that whole scenario of started raising money, had another follow-on vehicle that was raising money, and really couldn't get traction from the vehicle that the system had committed to.
Okay. So moving forward, do we have anyone ready to make a motion?
This would be on the private debt recommendation.
Correct.
Okay, Shanice, are you still with us?
I am definitely here, but I am not ready to make that motion unless Christina give me the word.
Well, I'm for this recommendation. We
Okay.
did a lot of extensive research on this and we got our questions answered. If we had gone negative, I would have said, or we didn't get our short dollar commitment back, I would have not recommended it because they didn't bring it up. But again, people move. This was probably their predecessors and different fundraising committee. So I'm happy with the private debt recommendation.
All right, well then I move to invest $10 million with Strategic Value Capital Solutions Fund 2 as recommended by investment consultant ANCO.
I
Is there a
second.
It's been properly moved in second. Sue, can you do a roll call vote, please?
Christina Bennett,
Yes.
Louis Cross,
Yes,
Sheila Goodwin,
she's having.
Yeah.
Oh, okay.
Shanice Johnson,
Yes.
Donna Jones,
Yes.
Martell Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
All right, so we have 9. The motion carries. So this is a recommendation that we'll present to the full board at the June meeting. So Jeff, will they wait until we fully, the trustees fully approve it before they work on that feeder fund?
I would say that's probably the best course of action, just to let them know it was approved in committee, but still needs to be finalized. And that they probably want to at least hold off moving forward until that period. And if they come back and say, well, that's going to create a time crunch, we can let everybody know. But again, based on what we've said, I don't suspect that ends up being an issue.
Okay, thank you.
And I don't believe our attorney will have an issue with that if we definitely do the Delaware fund.
I think that was the only thing that he had objection to.
Mm-hmm.
Yeah, I mean, we talked about it and it would obviously be preferable if we have other investors in that, but certainly need to have that domicile here in the US.
Okay.
All right. Do we have anything else on the agenda?
Nope.
Yes.
All righty. Bobby, you're up.
I would like to make a motion for adjournment for today investment meeting on April the 20, 2023.
Doris, can you give me a second? Doris has been provided second. All those in favor?
Second,
Aye.
second.
Thank you, everyone, for this very extensive meeting. You know, this won't be the highlight of your day, but Jeff, you did a great job with the custody.
It really did.
It brought it down, again, Jeff, it brought it down to our level to be able to understand everything that custodians do. And it just gave an overview. And so when we do the RFP and we go through the interviews, I really would like to get that chart back in your presentations that showed us the different buckets or circles, so that when we go through it, we can remind ourselves of all the things that they do or they don't do.
And what we'll do with our final summary piece of all of the information is we'll add some nice colorful things to that too, so we can keep everybody awake.
And you know, Jeff, one of the things and some of the things that we had NEPC do at the tail end of their contract was sometimes our our trustees don't know what to ask, right? They don't know what questions to ask because it is so in-depth investment knowledge, right? And so we would, I would submit questions to NEPC and then I would say, hey, look, in your presentation, can you put on the back like a little glossary chart of what things are? 2, can you add some potential questions so for us, I would always say, hey, look, Shanice or Doris, can you take question number 2, question number 3? And that way we read the material and we all participate in the RFP process. And it gives us a little snapshot to be able to just improve the knowledge across the board if we have glossary and questions that we might ask. And then any other cheat notes that you can provide for the trustees.
We can do that.
Fantastic.
I appreciate it. Thank you, everyone. Have a great meeting. Great weekend. I'm sorry.
Have a good weekend, everybody.
Take care,
Bye,
everybody.
everybody.